All right, so today we'll be looking at how do we avoid panic selling in this challenging time. So last Friday there was a sell-off. That is President Trump announced that there will be 100% tariff against China. So because of that, people were panicking. And the S&P 500 sold off about 3%. So Amazon, Google, all of those sold off about 7 to 8%. So that's why I consider that this Sunday we can consider the best way to handle that kind of situation. But as of 7 p.m. today, the stock market already reversed, meaning Trump announced that the issue between US and China will be all right. So many they start turning down their tone. But last Friday, the tone was like they will retaliate against China. So, but most of the time, no, they will. As in most of the time, they will promise to do like prove to be tough. But after a while. There's something we call taco, as in Trump always shaking out. So since April, he has been doing that. Like he will, like as in prove tough when he's talking, then probably after a few days, then mellow down again. So they have the time for him. Trump always shaking out, but he has done that again today by 7 p.m. So the market already picked up again. So people that sort of as like panic selling, like who quickly got out on Friday, they might be regretting it as of now because 8 p.m. the market already open for some people, but the market already rebounded to about more than 1% already. So by tomorrow, probably we will recover all the 3%. So I consider it will be I think a good idea to look at how to prepare for something, such a situation that we will not have to panic whenever there's such news. So there's more government shutdown, so all of those also has impact on the stock market. And there's renewed trade war, which is what Trump did on Friday between US and China. And by tomorrow too, we're gonna have what we call third quarter earning kickoff. So usually earning season will be a catalyst. Catalyst is something that will make the market move. I mean, that will prompt the market to move. So when those companies are doing well, then the stock market will begin to go up. So that was the expectation for beginning from tomorrow. But there was a mixture of thought on Friday, so we weren't sure if people will be concerned about trade war between US and China, or if they will be excited about company reporting their earnings from tomorrow. But as of now, since Trump already like turned down his tone, then probably it will be good news when the companies start reporting tomorrow. So, with all of this situation, now how do we avoid panic selling in such a challenging time as this? So, number one point is that we need to expect and accept it. That is part of the game. So, there are when it comes to the stock market, there's gonna be up and down. So we need to expect it and we need to accept it. So we expect and accept that it's part of the game. And we should ask ourselves, how did we get here? When I say how do we get here, I'm talking about, let's use this as an example. All right, so the stock market S&P 500 already rebounded 1.07. So last Friday, it's run down all the way to -3. So by now, we are up 1.07 already. So probably by tomorrow, we'll recover all the 3%. And Bitcoin sold off all the way to like 110,000. Now it's back to 115,000. So it moved from 125,000 all the way down to 110. So it's back to 115 now. So when I say how do we get here, that is, instead of panicking, you can ask yourself a question of how did we get here? So let's use this as an example. Okay, so AGNC. So last Friday, it went down by just about 1%. But when I say how did we get here, meaning I bought it around here, which is like nine something, $9.11. It run all the way to 1046. So as of Friday, it's down to 990, 993. Now, how do we get here? Meaning my basis, cost basis is $9.17. Then I shouldn't be panicking when it's now 993, because for me, I bought it when it was here. So that's the question I'm saying. How did we get here? It meaning, when did you buy that stock? Or if it's the S&P 500, when did you buy? So that's your cost basis. Now, but if you buy when it run up this high, okay, then you'll be panicking. So usually the stock has already run all the way here, usually I won't buy. I might still be holding it, but I call it margin of safety. So meaning I won't buy this high again, because anything that happen like it's crashing now, people will be panicking. But so for me, I have my basis like 917 here. So all this reaction that is setting up here, it doesn't bother me, because this company, they paid about 14% dividend. Okay, they pay 14% dividend. So the company selling off about 1%, I will still recover it every month. This is yearly dividend. But if I divide 14.5 by 12, I still have about 1 point something every month that I get from the company. So if they sell off by 1%, even though if they don't recover by next month, I will have recovered my losses for Friday, because every month I get paid 1.2 something dividend. No, yearly will be 14 point. So that's what I remember. How did we get here? My basis is 917. So whatever is going on here doesn't bother me, because my stock is still profitable. But apart from that profit, every month I still get paid 1.2 something to make it 14.5 in a year. So without understanding, there is no need for me to, so there's no need for me to panic. Like what happened on Friday, that is, I expected it and I accepted that it's normal. Normal as a part of investing in the stock market. Then I will ask myself, how did it get here? So minimum was my cost basis. I've not lost money even though the market went down. I'm still profitable. And the stock in question, even though if it goes down, I will recover from the dividend about 14% per year. And another point, we should focus on percentage gain, not the dollar loss. So as of Friday, I'm down $25,000. Now that doesn't move me. Why? Because that is just about 3%, that's just about 2% down or only. Why? Because within 3 months, I'm off $45,000 already. So if it goes down by 25, I still have $20,000 profit with just 3 months. So I'm gonna focus on the percentage, not the dollar, because by tomorrow, if we recover, I can go up by 20,000 within few hours again. So I'm not gonna be looking at the dollar amount. I'm gonna focus on percentage. So this year already I'm up about 42%. So if the market does whatever it wants to do and I go down by 10, I won't panic because I still have about $30,000 profit or 30%, 30% left. But I'm just gonna be looking for when it will recover. So we'll focus on the percentage, not on the dollar amount. Then the last point here is that the drawdown is from the peak. It's not from my cost basis. Like the example I showed us, I bought AGNC for 19, no, $9.15. It went all the way to 10.45. Then from 10.45 it's now down to 9.93. So I'm gonna be looking at it from 9:17, not from 10:45. But the people that jumped in at 10:45, those people have a reason to panic. So meaning the drawdown is from the peak. It's not from my cost basis. So I'm still good. If I close my portfolio today, I'm still gonna have about 20 something percent profit. I know I've gone down from 40, as in like a month ago, 40% all the way down to 20, I'm probably 25 left there. But I'm just saying if I close my account as of Friday, I'm still gonna come out with 25% gain as this year. Okay, so I don't have a reason to panic. I expect that it's part of it. I accept it, and I'm gonna focus on percentage gain, not on the dollar. And also, I'm gonna consider where I join in, which is my cost basis, not the peak. Okay. Any question about how to avoid panic selling during market sell-off? Question or thought? Mhm. All right, there's none. We'll move on to the
Yeah, what?
next. Oh, okay, go ahead.
Yeah, I got a question. Is what if your cost basis you got that 10 or you got that 9 and it still makes another jump down or gap down? What would be a reason to say, man, this thing is your thesis is wrong, I need to take my losses and just close the trade. What point would that be?
Okay, so and that will be the next PowerPoint. So if I buy it for 917 here, for this stock, I'm considering my 14, as in regardless, I'm gonna get 14.5 per year. So I will still be okay for this thing to draw down from wherever I bought it to like 4 or 5%, that I will have 9% left. But if the so for now I have a trailing stop on this stock for 6%. It means I'm telling the market if this thing goes down by 6%, then get me out. So to answer that question, if it goes down by 6%, that's when I will get out. That is, I have 14, but I'm willing to give away 6% and retain 8% or 8.5. Okay, so on this, so that's what I already put in there, a trailing stop. That is, uh, okay, anyway, do you know how to do a trailing stop? As in, do I need to talk about what trailing stop is, or we should move on?
You can talk about it. You can talk about it. Talk
Okay,
about it.
trailing stop is you you go to your as in your broker you using, you click on on your stock, and then you say sell. Then there's gonna be an option. So you click on trailing, as in trailing something following. Stop. Then I will put a percentage or or a value, but in my own case, I put 6%. So I'm saying I'm willing to lose 6%, but after that, they should sell me now. So that's what I did on this.
Is it kind of similar to like a stop loss order?
Yes. So stop loss is there are two versions. So there is a stop loss that you put, like, let's say you bought this thing for $10. You put 990 as your stop. But in my own case, trailing, the difference between the stop loss is just one. Trailing is, if as it going up, the percentage will continue to follow it.
In this situation, does he have a trigger?
Yes, a trailing stop. Let me see if I can explain it better this way. Hold on now. So this is also a stop loss, but it's called trailing. So let's see the meaning of it.
Yeah, because the reason why I'm asking that question like that is like, sometimes when you put maybe because I get confused a little bit about it.
Oh, okay.
Sometimes when one puts a stop loss or trailing stop,
Yeah.
that thing could sell off at a time that you really don't want that thing to sell off. That's the confusion I've been having with that because with what you're saying right now, you have to be exact about like the percentage that you want it to actually sell.
Yes.
Yeah, right. Okay. Okay.
Okay, so so trailing stop is that, for example, if you buy a stock for $100 and you set a trailing stop of 10%, it's your stop loss, but it's called trailing this time. The initial stop price is 90. So meaning the first time you sell it or you set it, if the stock goes down by 10%, they will sell you out, not necessarily 90, but As in, it could be 89, it could be 88. But once it reaches 90, they will sell you out. But it doesn't mean that they will sell it at 90, but they will sell it 90 or below. Now, so let's say tomorrow the stock now move on to 120. Your trailing stock will now be 108. So meaning trailing stock, meaning the price is moving up as the value, no, your stop is moving up as the price is moving up. The same thing. If it start going down, let's say it's now 95, your stop now may be 88, 80, but the percentage will be counting. But the meaning of this is that if there is a panic that the thing goes down by 10% at once, that's the meaning of trailing. That if there is a, like, for whatever reason, it goes down by 10% at once or rapidly, that's when this will kick in. But if it's not like violent, if it's not rapid, it's not gonna kick in. So that's the trailing stop. But the stop loss itself, th- that one is a set value regardless. So let's just say stop loss. So stop loss order, the difference is if I buy a stock for $30 and I set a stop loss of 28, my share will be sold whenever that price drop to 28. So that's the difference. Trailing one, if we keep going up, my stop loss will keep following, I mean, like going up with it. But stop loss is not gonna go, it's gonna stay at this price. Stop loss is whenever it goes down to 28 or lower, I'm telling my broker to sell me. But trailing, I believe that that stock will do well. That's when you put a trailing there. But if it's as if an unexpected situation happen, then that's when the trailing stock will kick in. So trailing stop is for like unexpected situation. Your stop loss is like a concrete value, but trailing, it's gonna keep moving as the value or the price of the stock is moving. Exactly.
That's fair enough, sir. Thank you. Yeah.
Okay, okay. All right, so the next point is we need to prepare for market sell-off, or we need to prepare for unexpected situation. So how do we prepare? You prepare your buying more fund. What I mean by this, I have some amount of money that I call it too good to be true. So when I set some amount of money aside for a true too good to be true situation. So I'm not gonna use that money unless I have that kind of situation. So that's how I prepare for it. So I have money in my portfolio, then I will have some amount of money set aside for when there will be a situation that, oh, this one is too good to be true. So this cash reserve gives you a protective stand instead of a fearful one. So during a major sell-off, you transition from being a victim to being a prepared buyer. All right, so at beginning of this year, I said my position about the market was because the market has gone up for like 2 years in a row, 2023, 2024. So my thought was that I'm talking about the beginning of this year. My thought was it wasn't likely that market will go up this year. So I will be buying only dividend paying company or stock. If the stock go down, I will still get paid dividend. So that's what I was doing February, March. But by April, when President Trump announced tariff against most of the countries, then that created a too good to be true situation. So that changed my stand about this year, that the stock market went down all the way to by 18%. So if it reaches 20, that's what we call a crash. So the market almost crashed in April of this year, starting from April 10. So that created a too good to be true. Then I jumped back in. So that's how I'm able to make 40% gain already by August. Yeah, by August of this year. So meaning when the tariff were announced in April, it created what I call too good to be true. Then my reserved money, I jumped back in to buy Google, Amazon, Nvidia, those growth stock hood. Then within 3 months, I was able to make about 40% profit. So that's another way to prepare. That is, we will have or you have some fund, put aside for a too good to be true situation. So that's another way to prepare for a sell-off, that you will not panic because you have some money to buy. But on Friday, I did not buy. The reason being that the market, let's go here. SPY. This represent uh the market. Okay, so from April of this year that I mentioned, from all the way here, the market through, the market sold off all the way down here. Then probably April 11 or somewhere, I jump back in from here. Then we run it all the way to 600. And so by September of this year, I stopped buying. So that's why I didn't buy on Friday. This is what happened on Friday. The reason being that it already run up. So I apply what I call margin of safety. Meaning at this time, I'm not going to be buying growth stock like Google, Facebook. I will only be buying dividend paying stock as of now until something else happens that make it a too good to be true. So that Friday 3%, that's not a too good to be true situation for me, because we started from here in April and we run it all the way here. So up from here, it went down to 18% down. Then from 18%, we are now at 15. So that's 33% profit already, because this was negative 18 and it recovered here. Then from here to here, now we are now like 15%. So minus 18 plus 13, minus 18 plus 15, that will give us 33%, meaning whoever buy here will have made 33% profit. So this time I'm no more buying growth stock. I'm comfortable, or I'm okay with the profit that I made this year. I'm only gonna be buying dividend paying company until another situation happens. So this situation is not too good to be true enough for me. All right. So So number one, we should expect it and accept it, and we should answer all of these questions. Number two, we should prepare for it. That is, have some money set aside that you'll be able to take advantage of the market or the situation. Then number 3 point is that we should maintain a defensive portfolio structure. So that's what as in that's what I've been doing since January. By April, when the situation changed, all I have to do, or all I did in April, is to buy more of growth stock. When I say growth, I'm talking about technology company like Google, Amazon, Facebook, or Apple. So all of those, when situation is good in the market, those one will run off very quickly than the dividend paying company. But when we are in bad situation, dividend company will still be paying you. So that's why as of now, I will put more of my money in dividend paying companies. So this is what I say. Shift to more dividend paying stock after a high run. So as far as I'm concerned, we are in a high run situation now that the market has run up. I still have growth stock, but probably only one. Then the remaining stock that I have now is dividend paying until situation changes again. So, so another way to prevent panic selling is to maintain a defensive portfolio structure. That is, you have a mixture of dividend paying as well as growth. But I'm the one that added this, that this is my own situation is that when we get to a place that the market has run up, I will shift more of my money to dividend paying than growth stock. But when situation changed, like in April, I bought more of growth. So within 3 months, I was able to do like 40% profit. But by September of this year, I've already restructured my portfolio. That means sold off Google, Nvidia. That's all the growth stuff that I sold all of them except Amazon is the only thing I'm holding for now. But all the money I moved them back to dividends. So that means if the market goes down, I'm still gonna be getting paid dividend until situation change. So the last point here is that by focusing on a long time gain, that is, we should focus on a long time gain. We have cash reserve and a balanced portfolio structure. We can look forward to an eventual recovery from a position of strength and non-panic. So if we have a long time view, which is what I've been saying to last year when we started the training, that is I'm not concerned about what happened this month or last month. I'm looking for the next 10 years, next 20 years. But I still have to be doing something every day or every week. But what I'm doing every day, every week is following the trend in the market. And based on the trend, I will be adjusting my portfolio. That is, when I feel that the market has run up, I will sell the growth one and then move the money to dividend paying stock. Then also, as I'll be waiting until when I feel that the situation now is not like too good to be true, then I can start buying growth stock again. But that doesn't mean, like for example, Google. Let's look at that. Okay, I wanted to say that doesn't mean I will maximize my profit, but from statistics, it said nobody does it. Does it meaning that you jump in at the bottom and come out at the top, as in nobody does it consistently. So I shouldn't expect that I'm gonna be jumping here and come out here. So I came out somewhere here. Oh yeah, 233. So I should be okay with that enough profit. So in June of this year, I was at Trashmore that time, I was exercising. Then when I checked my phone, I saw that Google went down by like 8%. Then I read the news of what happened. They were being sued by FCC or like monopoly of search engine. So usually I know they will resolve that issue later. Then I jump into buy about 100 shares of Google at this in June of this year. So I stay with it all the way to see to that's from 160 here. Something somewhere there, 160 all the way to 200 and but when there was a news there that when they resolve it, as in there was a news that they don't have to sell out Chrome, then it jumped up here. So I was expecting that it's gonna go down back to this place. So I saw this somewhere here. But what I'm saying in essence is that it is not every time that I will run it all the way to the peak, but I'm okay taking my profit somewhere here and then wait again for another situation. So that's an example. So I say that's like $5,000 on my probably on 15,000 investment. So I'm okay with that, as I was okay with 233 when I sold it. But my expectation was that it's gonna start going down from here. But it went all the way here before. But it's now going back down. So I can jump back in when it's like 200 now. All right, so that's how to avoid panic selling. We should accept it. We should expect it and accept that it's part of investment. We should prepare for it by setting some amount of money aside. And three, we should maintain a defensive portfolio. That is, if the unexpected happen, I will still be all right. But the way I do that is I maintain mostly company that will pay me dividend. Okay, so any question?
Yes, I
Question,
have a
probably
couple of,
the situation
I
in
have,
the market. Okay, go ahead,
I have a
sis.
question and two questions that I think that when you said that too good to be true, it's
Yes,
subjective, isn't it? When you're saying if it's too good to be true for you, might not be too good to be true for somebody else. Is there like a barometer of something that is subjective to anybody that can say that this thing is good to be true? I think is an opportunity. I'm going to buy, get buy, bam. Or because when you're saying that you see it and you feel that it's too good to be true, you get too at least I know when it's too good. I know, I mean, from my own standpoint, I know certain things that I look for, but I don't know whether it's something that to say that this thing is because we're discussing that the market was too extended last week,
yes,
and but now we're seeing a sign that this thing might be good to die, but we don't know whether it's when is the point at which it's too now when it becomes too good to say, man, I think this is enough to with confidence, with certainty that I think this is a range that I am comfortable with to pull the trigger. That's
okay.
one question. I have another one, but
And that's
that's
how I did that was. And so when it comes to investing, we have general principle that we follow. But at the end of the day, it's still gonna be an individual decision. So general principle is like they say, no, what's it called? Margin of safety. That is, when the market start going up, don't continue to get excited by it and keep buying. As at one point you need to stop. That's a principle. But now, who determines when to stop? That will now be an individual thing. So margin of safety is what Warren Buffett says, but I don't have to go and ask him now, where is mine? So I have to be, I will be the one to determine where my margin of safety is. But if we are talking about a specific stocks, like the one I used as an example of AGNIC, so since they will pay 14.5% as dividend, I'm willing to go I'm willing to like lose 6%. So my margin of safety will be I mean like you know, range of 6%. That if this thing goes down by 6%, I'm still okay. If it's running up, I won't keep buying, I'll stop. So to answer the question, it is subjective. That is, you have to determine that by just a principle. That is, principle meaning principle applies all the time, but how you apply it will now be an individual thing. Does that, as in, is that good enough?
Thank you, sir. Thank you. Thank you. That's good.
Okay,
Yes.
okay. Yes.
Yes. The other thing I'm a little bit confused. I know the answer to, but I want to ask because of something you said that we shouldn't sell, we should buy, we shouldn't sell. But you're saying something we shouldn't sell, but sometimes you're saying to take profits. But you're telling us, you're saying don't sell. I don't know, maybe I'm the one saying it like that. But do you know what I'm saying? You're saying don't sell, but you see, you said that you you're gonna you sold certain things, but you're saying that. So I don't know. I'm just. Do you know what I'm saying, sir?
Okay, I don't.
You,
What I remember saying is that we should have a long time,
yes. Okay. Yes.
like
That's what. Yeah. Yes.
this,
A long time. Yes.
this
Yes.
one.
Yes.
Okay,
A
okay.
long time. But that isn't that the same thing as not selling?
Not necessarily. I
Okay.
want to make this one bigger. Okay. Okay. So what we're saying is that by focusing on your long time gain, as a long time view of the market, and also cash reserve and balance structure, you can look forward to an eventual recovery from a position of strength and not panic. So now what we are saying, Esther, is that you will be the one to determine when to sell your stock. You may decide not to sell for tax purpose. That is, I don't want to pay tax on this year, or I don't want to pay short time tax. If I sell a stock that is less than 1 year, that I've not hold it for 1 year, my tax on it will be short time, which is equal to my ordinary income. But if I hold it for more than 1 year, you will pay capital gain, which is either 0, 15, or 20. Depends on depends on your income. So meaning if I'm trying to optimize my tax situation, I may decide not to sell a stock. And at the same time, there are some tax situation too that when you sell, it is beneficial for you. So it's an individual thing. But when I said long time view, I'm not saying we shouldn't sell. I'm just saying looking at the market generally speaking, we should look at it with a long time view. That is, what would the market be like in 10 years, or what would this company be like in 10 years? That's what I mean by long time. But when situation warrant, we can take profit. So like Google now, I bought it at 160. I was holding on to it till 200 and something. So at two something, I felt. So that's an individual thing. I didn't have to ask anybody. I felt that this thing may start going down. So that's just my own feeling. But that doesn't mean I was right. So there is no right and wrong in this situation, but I was profitable. As in 160 all the way to 230. I decided for mindset that that was good enough profit for me. Some people may still hold it all the way to 250. That's for them. But whoever buys at this point, those that bought it at 256 or 251, they will be the one panicking now. So that's what we're always talking about, having a long time view, long time meaning if I buy here, I can keep holding for the next 10 years, even though if it goes down, it will recover at one point. That's what we mean by long time. But I can decide that based on the general situation in the market, I'm going to sell Google and go buy dividend paying company. Does that answer the question? As in, it's case by case, that is, general view of the market should be long time, but there will be situation that I will determine I'm going to shift.
So what I understand you trying to say right now is that
Yeah.
we could be pragmatic about this, right? That it depends on your own situation, but in that case, shall we say it's too conservative to imbibe the idea that okay, we can get in a situation where let's say when the Amazon went to as high as $3,000, are we too conservative to say maybe I will just hold on Amazon like that? Will come a time that's going to actually go high like that, or it's more ideal to be pragmatic, like you say right now, that maybe it gets to $500 and you say, okay, maybe this is the time for me to sell it.
That's what I'm saying, that it depends on your on that person's situation. So my situation for Google is when I heard the news in June, I bought it, waiting for when the news when the station will be resolved. Then it wasn't resolved until like September something. So I was still holding it to like till September for 3 months. Then when the situation was resolved, people were excited. But me, I got out like 230 here. So the reason I got out is that it was the news that brought it down, not the general market situation. So when that news clear, I can decide if I should get out or still stay there. So principle, we are looking at a long time view of the market, but from time to time, situation in the general market might warrant that you should move your money from growth stock to dividend stock. So I'm still staying in the market, but I'm moving from Google to AGNC. That's just very different. I'm moving from Google that doesn't pay that don't pay a lot of dividend to the one that is paying 14%. So does that answer the question?
I'm clear on my own part, yeah.
Oh, okay, okay. So it's gonna be an individual thing, or I can call it an ongoing thing. I'm gonna be watching the general market condition, and I need to ask myself, why did I buy this? I bought it because of the news that happened in June, and I was expecting that at one point they will resolve it. Now in September, it has been resolved. it jump all the way here, then I know that this thing keep moving now. It just people are just excited now. There is no more new news. So for me, at this point, the general condition of the market warrant that I should get out of Google and go to dividend paying company. So that's the general view. That's my general view of the market now. Not the individuals. So the market generally has run all the way up negative 18 in April. Now it's positive 15, so that's 33%. So for me now, I'm comfortable just receiving dividend until situation changes. Do we have any other question? All right, I can stop sharing.
Actually, I
Let's.
have one more. One
Oh,
more.
okay.
How do we position ourselves for next week coming? For week coming?
Okay, so next week now,
Yeah, or this week. This
the
week. Today is
yeah,
Sunday, so
okay,
this week. How do we position ourselves?
this Sunday job, but there is what we will do. So this is my position now. SP SPY. So my position is still that this thing has run from April all the way here. That's 33%. So for me, I'm still gonna be buying dividend paying company. And example is what I've shown on AGNC. So that's where I'm still standing now. That is what happened on Friday wasn't a too good to be true situation for me. So I didn't buy. I didn't sell anything. That's why we're talking about avoiding panic selling, but I didn't buy. I just no, I just consider that it's just not part of the. So going to next week, I will still be buying dividend paying company. All right, so it's been wonderful having all of us there for about 1 hour. So next week, if we are looking to buy my, as in what I will consider buying will be company that pay dividend. That is, I see things that the market has run up. That doesn't mean there's no right and wrong in the market. There's no certain. Okay, let's use the word certainty. There is no certainty. There is only probability. So so where I'm cheating towards is the market has run up. I'm gonna be buying dividend paying companies so that the unexpected happen, I will still be getting paid dividend. All right, so let's stop sharing. And I can stop the recording then if we just want to talk, we can.
Thank you so much, sir.
All right.
Thank you so much.